This could make you thousands of dollars. It is not the most glamorous way of making money. It's also not some scheme like a pyramid scheme or a pump and dump. It is a tried and true method using T-bills to make money. Now, I know what you guys are thinking. If you're here, you probably want growth stocks or growth ETFs or dividend ETFs, but this is equally as important for your portfolio. We're going to cover this fund today, and I'm really excited. Huge shout out to Neos because this fund is a Neos fund, and they are some of my favorite ETF providers. If you don't know who I am, my name is Spencer and I talk all about investing. I have two YouTube channels, Spencer Invests and Spencer Invest Stocks, as well as a podcast with Marcos Mia, a very popular growth ETF YouTuber called The ETF Guy. So check that out if you are interested, but let's get into this video. We're going to cover how much money you would make if you invested $10,000 into this particular T-bill ETF by Neos for 10, 20, even 30 years. Ticker CSHI. It's been doing really, really well. We're going to cover all of that and more in this video. Thank you guys so much for watching. If you are here, don't forget to like and subscribe. We are growing slow and steady on this channel, and I really, really appreciate it. Let's roll that intro. If you guys like ETFs, specifically income ETFs, then Neos is probably the company for you. They have some phenomenal ones, SPYI, QQQI, IWMY, and some new ones that I will be talking about in future videos. So you definitely don't want to miss out. But CSHI is right here. It's the Enhanced Income 1 to 3 month T-bill ETF. If you don't know how T-bills work, they are a remarkably safe form of investing. And with that safety comes a typical lower yield. But CSHI doesn't care about that. The distribution rate is 5.18%. I know what you're thinking. What? MSTY is yielding 100% right now. ULTY is yielding 80%. But listen to me. This is consistent. And if you wanted those high yield savings accounts that you could have had post-pandemic, but now they're down to 3%, 3.5%, and you're missing out on that extra money, this is the fund for you. Now, I don't own it yet, but here's my plan. Here's what I'm going to do with it. I want to use all of my uninvested cash in CSHI. I've been going back and forth comparing this one to ticker WEEK by Roundhill. That is a weekly ETF, but it doesn't yield as high. It's about a 4.2% yield, but again, it's paid weekly. So compounding can be in your favor, but I do like both of them, and I'm struggling which one to pick. I'm leaning more towards CSHI because that 5% plus is just amazing. Now, the gross expense ratio is 0.38%. It is a little bit lower than WEEK, I believe, and although it pays monthly, I'm really, really excited. We're going to talk all about this fund and how much you'd actually make with investing in it. But I first want to look at the chart and the distribution history. It's very, very important. And if you want to go on Neos' website, I recommend it. Check it out. See if this fund is something that you would like. They also have something that is the index options. They're section 1256 contracts, and they're subject to lower taxes as well. It's just, there's so many pros to this fund. I'm really, really excited about it. And if you like T-bills, but you don't like doing all the work of re-upping them every month, every 3 months, every quarter, like some people do, this fund might be for you, especially if you don't mind paying that little bit of an expense ratio to cover that. In case you didn't believe me on the security of this, it literally trades between what, 50 and 49.90 over and over and over again. Sometimes it goes a little higher, sometimes a little bit lower. It did drop to 49.01 once. Bounce back up. Don't know why it did that, but low average volume. It's not the most popular ETF, and it's not going to be. This is not supposed to be something that you have as like the highlight of your portfolio, right? Because inflation can get up to 4%, even higher. I've seen it. What's the highest we've seen it? 7%. But still, you can outpace inflation with this and still have that money. You can sell it right away and purchase whatever you want to if something comes along that you do want to have. Right now, I'm just holding it in an average fund. And what I really want to do with CSHI is move my emergency fund into it. So if you guys don't have an emergency fund, I like to keep at least $5,000 in an emergency fund. You can actually make some decent money on that while holding it and never spending it, which is exactly what I think is so powerful about this ETF. Now, if you want weekly payments, again, you can use WEEK. These two are still, they're so head-to-head in my opinion, but we need to check out the distribution history. This is not a new fund like WEEK is. It's been trading for quite a while and been paying since September of 2022 pretty regularly. Now, we do see it fluctuate, and it is going to likely continue to fluctuate because it's depending on the T-bill rates, which all has to do with interest rates. We can also see it pays absolutely every single month. You love to see it. Can't really complain about it. Payments range ever so slightly, but it's very consistent. And that's what we're looking for if you have something with your emergency fund, right? Because you don't want to have something that drops in price, that drops in value, and then all of a sudden your emergency is $5,000, but your stock is down 20%. You only have $4,000 in there. What are you going to do? That's not what we want. Because I've thought about that myself, like, oh, just put it into S&P 500 ETF, just put it into something else. But seriously, I like the distributions, and you can actually grow your portfolio. You can grow your emergency fund relatively risk-free. Using Dividend Channel's drip calculator, check this out. It is just so consistent. So what we've seen, it's been paying for just under 3 years. And in that time, if you had invested $10,000 in 2022, you would be sitting at $11,640. You would literally have made $1,640 for just having an emergency fund in that 3-year period. Phenomenal. The average annual total return is 5.46%. Total return 16.42% with dividends reinvested, which I would do because, again, I want to grow this emergency fund. And once you get enough in there that you're comfortable, you can move that out of there and put it into your normal stuff, your higher risk stuff, whatever you want to. But it's just really, really solid that this thing pays so consistently and such a really, really good yield, I will say. The main reason I'm talking about this, I went to open a high yield savings account, and I'll be transparent, I went to use SoFi. They offered me 3.8%, and you had to use their premium access. And what that meant was I ran the numbers. You'd have to basically have, like, it was a couple thousand invested. I think it was around 7,000 or 8,000 invested just to recoup the loss that you were to pay for the high yield savings account, which makes sense, I guess. Like, if you're going to have 50K in a savings account, a high yield savings account, you wouldn't even bat an eye at that. But I'm not. I'm going to keep it just to my bare minimum of my savings, my emergency fund, and then I want to move that money out of there. I want to move it around when I need to, especially the earnings that it makes. So that's my thought on that, and that's why I dove into CSHI and why I've been very, very impressed with it. So what we're going to do now, we're going to do a calculation. We're going to see, based off this average annual total return, how much money would we have if we put 10K in and we tracked it for 10, 20, even 30 years. And although it's probably not going to be one that we retire as a millionaire on, I definitely think the numbers will surprise you. I love running these calculations because it's so fun just to play with. I have drip off. We're getting paid monthly. We have CSHI plugged in, 200.72 shares. We're not adding any money and we're not getting taxed on it. Let's say it's in like a Roth IRA or something. Initial dividend yield 5.46. We're not increasing our dividend percentage or our share price appreciation. None of that's happening because we want the price to just stay stagnant like it has and like it's kind of designed to. So after 1 year, we've been paid $559 in dividends. And I know that might not sound like a ton, and it's not massive, but that's really, really impressive. Imagine just having an extra $560 a year to do whatever you want with. And again, you can drip it if you want to. I might run the calculation again at the end with drip on just to see what happens, but I'm still very, very impressed. After 5 years, you're still sitting at that $9,999 initial investment, but you've made $2,800 just on your distributions. That's amazing. That's absolutely amazing. I mean, yeah, $3,000 extra. I'd love to see it. After 10 years, you're now getting $5,600. After 20 years, you've now made $11,200. And after 30 years, moment of truth, almost $17,000, $16,795. Now, again, that's with drip turned off. Let's say you're like, you know what? I don't need the money. Let's use drip. We're going to see the same for the first year. 5 year, it should be a little bit of an increase. Yeah, we're seeing after 5 years with drip on, you're now getting $3,130. 10 years, you're now getting $7,241 total. And now moving forward, our annual dividend income, because it is changing now because we are dripping, is actually going to be $965. And we're up $7,000 from our starting capital after just 10 years. I think that's pretty impressive. After 20 years, we have now received $20,000 total. Annual dividend income moving forward is $1,600. So now you could even stop using drip and just use $1,600 every year for a vacation, for whatever you want to, home improvement. Ending balance is still $30,000. You're making some great money on it. Last but not least, $30,000 with drip on. You've made $41,000 in dividend payments alone. Annual dividend income is just under $3,000. That's amazing. Absolutely love that. I know $3,000 isn't a ton of money, but our starting capital was $10,000. So now we're making $3,000 every year. Ending balance 51,000. You could really save up a nice, very nice emergency fund, which of course, I like the idea with using some drip because emergency funds should probably increase as you get older, as you have more stuff, you have more money, bills get higher, you're going to need more money. So let me know what you guys think. If you like this video, you're going to like these popping up on your screen right now, including our latest DGRO versus SCHD dividend ETF battle. Check that out. Let me know what you think. Don't forget to like and subscribe, and I hope to see you in the next video.